So you are a Canadian investor and you figure you got all your investment holdings all locked down with those big five Canadian banks. I'm going to say, think again. Today, I'm going to share a bit of a twist in my own portfolio strategy, and this challenges that conventional wisdom. Personally, I've always held at least two of the big five Canadian banks in my portfolio. The most recent, Royal Bank and TD Bank, I've held shares of these two companies literally for as long as I can remember. Well, I've recently added a new financial holding to my portfolio. Now I officially have an equity ETF as part of my holdings. And if you're a follower of the channel, you probably know that I default to owning individual securities. But now my new addition is the only equity ETF that I own. It's a fund I had not previously thought of, but as I went through some research recently, it became an obvious choice. I'm going to tell you more about that in just a few minutes here. But first, let's look at a typical Canadian investor's portfolio. If you are a Canadian, there's an overwhelming odds that you have investments already in the big five Canadian banks. A lot of people own them directly. You might own them through an ETF, through a mutual fund, through a retirement plan, through your workplace. And even if none of these apply, as of March 31st, 2023, the CPP Investment Fund owned all of the big five banks. So if you work in Canada, you contribute to the CPP. Yes, you do own the banks. Now, a lot of investors own more than two of our banks. And in fact, many own all five. And we call that diversification, right? You own the basket, you'll lower the overall risk, but you get the same return. And it makes a lot of sense. But I've come up with a better solution. In this video, I'm going to talk about the fund that I've just added to my own holdings. It's called the Hamilton Australian Bank Equal Weight Index ETF. The ticker on the TSX is HBA. And I want to share my logic with you as to why I feel if you're going to own more than two Canadian banks, this is a great addition to your holdings. Being Canadian, when we think about investing in financials, we typically think of the Canadian banks. If we're a little bit more adventurous, we might think of some of the big US players, like JP Morgan, think of the Citigroups, the Bank of Americas of the world. But I'm going to bet that very few have ever considered looking overseas to Australia. And I know that certainly I hadn't until recently. And I think I might have missed a bit of an opportunity. First of all, I want to look at some of the comparisons between our Canadian banks and those in Australia. And if we look back around 20 years or so, we can see by this chart on the screen here that the performance has essentially been the same. The Australian banks have slightly outperformed our domestic banks, but I'm going to call this a tie for all intents and purposes. But this is now where it gets a bit more interesting. Canadian banks are very highly correlated, so they act the same way. And in fact, the individual Canadian banks are so correlated to each other that the risk profile of a portfolio of three Canadian banks is almost identical to that of a portfolio of four or more Canadian banks. In other words, if you add a Canadian bank number 4 to your holdings, you're losing the benefits of diversification in the form of lower portfolio volatility. And at the same time, you're not going to be generating any extra returns. So this is what I did recently. Instead of adding another Canadian bank to my portfolio, which again sort of provides almost no additional diversification benefit, I bought shares of the Hamilton Australian Bank Equal Weight Index ETF. And this now provides me with exposure to another blue chip banking sector, similar return profile, similar yield as the Canadian banks, but with relatively low correlations. And the idea with this strategy is it will give me higher returns with lower volatility. That's if I use a history as a guide. When you have two assets that have similar returns but aren't closely correlated, mathematically you're going to end up with a higher potential returns and lower volatility. And I remember when I first heard this concept, it almost sounded kind of counterintuitive, but the math actually tells a story, and I want to look at an example here. If we look back over the past 20 years or so, starting back in 2002, we can see how this works. Canadian banks have given us annualized returns of 10.55%. Australian banks have given us 10.59%. So practically the same, no difference, right? But if you have a mix, or if you had a mix over the past 20 years or so of 75% Canadian banks and 25% Australian banks, you've actually generated a return of 11.31%. So I'm going to call that 70 basis points of a higher return. Now, over that same 20-year time period, if we look at the compounding effect of the portfolio return in actual dollar terms, this is what we're going to see here. With either the Canadian or Australian banks, a $100,000 investment would have grown to just a tad over $900,000. But with a mix of 75-25 Canadian to Australian banks, the final value would be just over $1 million, $1.05 million. And the kicker here, especially for an older investor like myself, who's in that sort of later stage of my investing career, the kicker is that this came with a lower level of volatility actually than if you had just invested in Canadian banks, which is actually what I've been doing for the last couple of decades. You can see that in this chart here. The standard deviation or overall volatility of the combined portfolio is lower than either the Canadian or the Australian banks just by themselves. Now, as I was learning more about the investment opportunities in Australia, I came across a few interesting facts, and I want to share those with you now. First off, Australia is one of the most successful developed economies in the entire world. As we can see by this chart here, Australia's average real GDP growth has outpaced that of these major developed countries over the past 20 years. If we look at this from a debt to GDP ratio, Australia comes in at roughly half of what we have in Canada. Australia at 0.6 and Canada at 1.1. And just to round out this economic picture, the Bloomberg forecast of real GDP growth puts Australia at the top of the G7 countries. Now, when we look closer at the financial sector, this is what we're looking at in this video here, Australia has actually one of the strongest global banking sectors with extremely well-capitalized banks. When we talk about Canadian banks, and we see this always with the reports, I always highlight the CET ratios, and this is the common equity tier. And this tells us a lot about how well our banks are capitalized. Our banks currently have a CET1 ratio ranging from about 12.4% up to 14.5%. Now, from a global perspective, our banks are actually considered to be well capitalized. And we look at that mainly because of the regulatory requirements that we have here in Canada. However, the Australian banks operate under one of the strictest regulators in the world, and the requirements for these capital levels are much higher than what we see here in Canada and also amongst their global peers. Requirements for banks operating in Australia are at least equivalent to the Basel III requirements. As we can see by this chart here, Australian banks' capital ratios remain well above the regulatory minimum requirements. As an investor who places importance on the stability of my investments, I find this to be quite reassuring. And as I was going through this process, I also looked at some of the similarities between Canadian and Australian banking sectors. And there's actually quite a few crossovers. And I just want to start, first of all, from a structural standpoint. Australia, they're home to a Big Five oligopoly, similar to the Big Six that we have here in Canada. And the strength with this type of an arrangement or a setup or a scenario is that it's virtually impossible for any new players to meaningfully break into the market. And there are huge, huge barriers to entry. So there's a similarity there. Another thing that you have to consider if you're looking to invest in this space is that the Australian banks have significantly lower acquisition risks than we have here in Canada. They have much stronger domestic focus compared to our Canadian banks, which historically have been more foreign expansion focused. Banks in Australia have historically favored dividends over capital deployment, have historically had higher payout ratios than the Canadian banks. And you can argue which of these strategies is superior. They both have pros and cons. But what I like about combining the banks from both countries is you end up getting the best of both worlds, you might say. Also, we all love our dividends that the Canadian banks pay here. Australian banks, too, have a strong history of very stable dividends. Australian banks have attractive dividends, and this is reflected in the yield of HBA, the fund I bought, of around 5%. Let's take a moment to look at some of the details of this fund in particular. So first off, HBA is the only Australian banks ETF here in Canada. Since the fund was launched back in 2020, it has an annualized return of around 20%. It has outperformed the Canadian banks over 1, 2, and 3-year time periods, as well as from inception. For the actual investments themselves, HBA holds an equal weighting of Australia's Big Five banks. We can see those listed on the screen here. They all come in at around 20%, and that portfolio is rebalanced semi-annually. The fund has quarterly distributions. It is 100% hedged back to the Canadian dollar, so this removes any currency risk from the equation. If we look at the costs, the management fee for HBA is 0.55%, and the management expense ratio is 0.70%. So I feel for a fund that's operating in the international market, this is very reasonable. The risk rating on the fund is medium to high. Before I sign off here, I want to speak for just a minute on a couple of topics. First off, there are some features of this fund that I find attractive when it comes to what the CRA is going to get their hands on. I like keeping as much of my hard-earned investment returns as I can. HBA is not subject to withholding tax, and this is due to the Canada-Australia tax treaty and the fact that HBA, the fund, owns the underlying stocks directly. Now, you can go and purchase ADRs on the New York Stock Exchange. So that's another another way you can get these. But if you did that, dividends would be subject to 2 layers of withholding tax. You first got the layer from Australia to the US, and then you've got that second layer from the US to Canada. So that's something that you need to consider if that's a route you want to take. Also, for Canadian tax purposes, Australian bank dividends are classified as foreign income. I also want to talk for just a moment about a question that people might have about the liquidity of an ETF, because when you're buying or selling an ETF, some investors are concerned about the liquidity of the fund itself. It's an important reminder for investors that an ETF's true or implied liquidity is measured actually by the liquidity of the underlying portfolio, not by the trading volume of the ETF itself. And this applies to all global ETFs. This is where what's called the market maker comes in. And market makers provide liquidity and depth to the markets. They make their profit from the difference in the bid-ask spread and the live NAV. These market makers, they can redeem units of the funds at their discretion. Their service, the service they provide, is reflected in an ETF's bid-ask prices, and that results in a modestly higher spread, typically just a few cents, versus the ETF's underlying net asset value or NAV. And I'll give you an example here. Just before I filmed this video, I pulled up this order on a screen at TD. As you can see here, the bid-ask spread for HBA was $23.69 and $23.77. So that's an 8-cent spread. The live NAV is typically at the midpoint of that spread. So you could expect around a 4-cent cost in this case for the liquidity that the market maker is providing. Importantly here, the greater liquidity of the underlying portfolio, the tighter that spread is going to be on the ETF market price. However, with HBA, the spread isn't reflecting lack of liquidity in the undervalue as the Australian banks are extremely liquid. Rather, it's reflecting the overnight risk that the market maker is taking on because the Australian banks are closed when Canada is open here. A tip for buying or selling ETFs: it's a good practice to use limit orders when you're buying ETFs and placing trades. This is to ensure that you get an efficient fill. It's also a good idea to avoid trading in the first or last 10 minutes of the market hours when the prices of the underlying securities tend to be a bit more volatile. I love the financial sector. It is the biggest slice that I have in my own personal investment pie. I kind of wish I would have looked into this international diversified portfolio earlier, but I didn't. So here we are right now. I have taken this position in HBA. I'm looking forward to its contribution to my portfolio going forward. If you would like to learn more about the fund, I will put a link in the description of this video. As always, thank you for watching this video. I'll see you in the next one.